The market has not lost sight of what we are doing, and we see the market cap of the bank now has grown significantly, as we said, to almost now be equal to the next three banks. The last time we were discussing here, our market cap was about the size of the next two largest listed banks. If we look at the numbers, we are now almost the size of the three next largest banks. So that takes us then to look at how the balance sheet looks like. And the balance sheet, as we have seen, has become fairly liquid, as we said. Very strong growth, 24% expansion of total assets during a period like this. It's something we really take pride in, but it is the structure of the balance sheet that is the strength of this group. While the size of the balance sheet is big, and we deeply celebrate being a 1.7 trillion shillings, we know from the slide, and Alex, you can take us back to the slide of the market cap, that it is not the balance sheet that counts. If it was the balance sheet that counts, if you added the balance sheets of the other three banks, the LIBOR, it will be more than double the size of our balance sheet. But yet we are. So we have realized there is much more than size. It's the quality. And if you look at our balance sheet, if we go back now to the balance sheet, you see it's the structure of the balance sheet. A very agile balance sheet, a very liquid balance sheet, and a flexible balance sheet. It will be able to respond to the external environment with the speed because of the way it has been structured. A high quality balance sheet. And as you can see, if we take those items that we have seen there, if you look at the asset side, the top three fast assets make more than 70%, meaning that broadly cash earning, yielding assets constitute more than 75% of the balance sheet. If you look at the liability side again, you see the concentration. And that again penalizes because the funding side, as we said, 72% of the balance sheet of our funding is customers' deposit. Customer deposit talks about the trust, the confidence that we enjoy in the marketplace. But during a time like this, when the government is able to offer 18% on treasury bonds, then you are competing with the bank, with the government. And the only way to maintain your deposit base is to match the government in terms of interest you're offering to depositors. And that is where literally. Then for foreign denominated assets, you are competing with the US. If the US is offering 7, unless you offer 14, as we see in the Eurobond yields, nobody looks at you. You'll have one way. So our liability side has really significantly priced because the funding is predominantly customer deposits. So we're talking about customer deposits is 72%. But if you look then beyond that, long-term debt is another 13%. And that 13% we said it repriced 4 times from 3 to 12 because it was LIBOR, and LIBOR moved from 0.25 all the way to 7, 6. So if you add 7% to the 3, you are already at 10. So essentially, that's how that balance sheet, and that's what we said, will not pass that cost to the customers, we'll take it through the P&L, we'll cushion the customers through the P&L, and hence the term, we have chosen the customer to profitability. But we know, like we did with the COVID, we supported them for 2 years. This time, as we have seen, the microeconomic environment has started to ease globally. We believe it will ease in due time. And so if we use this, we'll use it for a year or 2, but we'll remain with the customers for the rest of their lives, like it demonstrated. And we can see the policy. So that really explains the issue. When you look at the P&L then, we see, as we were saying, interest income grows at 32%. But look at interest expense. It grows at 58%, lowering net interest income to only 21%. But strategically, because of promoting African Continental Free Trade Area, we grow trade finance and Forex by 38%, giving us a total income growth of 28%. Again, look at the growth in staff cost, both and other operating expenses, because of the Kenya shilling depreciating, because of inflation, because of high interests that businesses are passing to the consumer. Our operating expenses grow by an average of 47%. And given that we have chosen deliberately and consciously to continue to lead in uncertain times, then we must also be willing to pay the price. And as you can see, we have put up our loan loss provision up by 107. That's just to make sure that we don't weaken the quality of our asset book. We cushion the balance sheet by taking it through the P&L. So P&L has 2 hits. One, recognizing the risk, and the second one of absorbing the cost that would have been handed over to the shareholders. Pay a slight price because of the P&L, and return on average equity starts at 25.1, and return on average starts at 3.1. The financial ratios look solid. Capital, as we said, strong. Yields, steady. Ratios, comfortable. And so this gives us a deep dive on the business. And we see the business fundamentals are very, very solid. The buffers of liquidity at 49, the buffers of capital 600 basis points above minimum, the buffers of yields, the buffers of coverage. That gives us confidence that as we step into the future, the bank is on solid ground. And that then gives us the confidence to do an outlook and a projection into the future. And we said the balance sheet is very, very solid. As we can see, we have not changed our forecast or prediction as to how the future looks like in terms of growth. The actual is right in the middle, so we are not changing that. The interest margins, we have said, we have realized that we are not able to pass the entire cost. So we have amended and revised our guidance on net interest margin, non-funded income mix. We have enhanced our expectation on non-funded income. We have toned down our expectation marginally on net interest margin. and we have upped the cost-income ratio. Return on equity, that has slightly been affected, return on asset, cost of risk, and NPLs, but subsidiary contribution remains the same, and we have increased the subsidiaries' contribution on profitability.